Let's talk about 3 more stocks that our research firm MacroOps is looking at this month. But of course, as we look at these things, you got to remember that stock picking is only 10% of the entire process of successful investing. The other 90%, what actually makes you money is how you manage those stocks once you buy them. So we're talking about when you buy them, when you sell them, when you take profits, when you add more, all those things. You need a full strategy if you're going to pull money out of the market. And if you're looking to see how our team does it, I put together a free training that you could check out. There's a link in this video and down below in the description and comments. It's going to show you how we make those decisions of when to buy and when to sell and all those other things I just mentioned. It's all broken down step by step, so definitely check it out. It's free. Now, in the last video we did, which was on May 23rd, we talked about one stock called POW, which is Ammo Incorporated. We were talking about how they have those cool tracer bullets that look like laser beams. Well, after that video, that thing shot up almost 36%. Is it because I made that video? Maybe. No, it's not. It's just because this thing was already coiling, ready to take off, and it has a really solid fundamental story. But it's always fun to get quick profits on something like that. And then another stock that I mentioned was Peloton. Now, the action that we've seen here since that video was released has been just more consolidation, really, because you could see Peloton took off and then right around earnings, it made that big jump. So normally after a big jump in a stock's price, you tend to see some sideways action as all of that consolidates. You know, stocks don't go straight up. They take breathers just like this. But what was nice to see is that there was a solid support level. So you can see right here on the day of the earnings when it jumped, or maybe this is the day after. Let me zoom in here. You can see this wick. So the way to read this candle is that it opened up here around 45.70, and throughout the day it dropped all the way down here, touched this point, but ended up closing closer to where it opened. So you get this long wick right here. And it seems as though that long wick was where the support line was, because it dropped all the way back down, right? And then obviously people came in and bought it back up to here. So for the next few days, you saw consolidation and you saw that that support level held. So right here, you see that really skinny candle. It basically closed at the same price, but you can see by these wicks that there is some volatility. So it shot up a little bit and it dropped down low below that support level, but it didn't stay there. It closed right on it. Looks almost perfect, right? And then the stock took off from there. So that's a sign of a healthy consolidation, because if we saw the stock price break below here and we didn't see buyers come in and keep pushing it higher, then that would be a signal that, hey, maybe the move is over. But if it's consolidating like this, then you might have a good entry point at a new high, which it looks like it's getting close to. And you know, some people would prefer to buy right off this support level. It's really up to you and your strategy. Now, as far as new stocks go, the first one I want to talk about is Tesla. Yes, I'm talking about Tesla. Not surprising. Everybody loves Tesla. But in this type of market, which we've talked about as a really retail fueled market, it makes sense to be looking at the most popular names because that's what everyone is interested in. And I was talking to Alex, who's my partner in MacroOps, and he was saying the type of rush that we're seeing of all these new investors into the market, we haven't seen anything like it since the 90s. So we're talking .com bubble. And of course, what are all these people investing in? The tech names, the popular names. And we had that data from Ameritrade, Robinhood, all those brokerages saying that's exactly what these people are investing in. Now, normally I would disagree with basing your investing strategy off just popular names. You know, like the whole Peter Lynch ideology of investing in what you know. So do you wear shoes? Oh, if you wear shoes, you should invest in Nike. No, I was never really into that type of investing strategy. Because first of all, just because you know what a stock is and you use the company's product does not mean that it's actually a good stock. It could be a terrible stock that's been going nowhere for years. The stock market does not perfectly reflect what's going on in a company. It's a little more complicated than that. And instead of actual fundamentals, stock prices are more based off people's emotions. That's why you get these huge trends. Not much logic involved, at least in the short term. And the second reason I don't like that strategy is because if you only invest in what you know, then you're really limiting yourself. You would miss so many trends because there's a lot of things you don't know, like all the weird stuff that Gen Z is doing all the time. Or we've already talked about our Becky strategy, right? And that's when you find out what white women between 20 and 40 are into, so you can see what the next big trend is going to be. That's once again something that you're not going to know unless you're a Becky, which in that case you got an advantage. Anybody remember that old Ply song Becky? It's a fantastic song. I added it back to my trading playlist. So in normal times, I'm not about investing in just the popular names or what you know. But in this case, with the retail rush, the trend is going to be in those names. And you know you're going to want to ride that trend until it bends, as they say. So going back to Tesla, you can see it made a pretty nice run from the bottom. And you can ignore all these markups, but I actually made them for that training. So this is just one of the trade examples that I use. So if you do want to get into that, then just check out the training. Link down below in the description, comments, and above in this video. But anyway, Tesla had a nice run, and then you could see that it pretty much consolidated here. It had a pretty tight range for a few weeks, not really moving anywhere. And here's the thing, when you see stocks coiling like this, like forming a consolidation, that means that a breakout is coming. But the breakout, you don't necessarily know whether it's going to be to the upside or the downside. good. In this case, we could see it already broke out very nicely to the upside. So that's your buy signal right there, depending on your strategy. So the first thing you like to see in a consolidation is that tight price action. You see that the price is barely moving, just every day staying in the same tight range. And not only that, but if you look at the volume down here, you could see that it's been decreasing the whole time. So that's a signal that there are some tight hands in Tesla, guys that do not want to get rid of their shares. If there was higher volume here, and you see this blue line is kind of the 10-day average of volume, if it was above that, then that would be the signal that, hey, a lot of people are trying to sell out right here. Could still be a tight range, but not necessarily strong hands. And when I talk about strong hands, I'm talking about those investors that are in it for the long run. So you want to see those people holding on to their shares, because if that's the case, then you're never going to see a dip too big. And I don't mean never ever, but at least in the short term. And then finally, you see some people buy in, and this is when you get the jump right here. And the jump in price coincides with the jump in volume right down here. See, it's above this blue line, which is the average. And that's typically what you want to see in a breakout, right? Price exploding higher with more volume. So lots of people buying. Those factors together make this look like a solid move. Now, on top of that, our TSI reading for Tesla is still very high. It's ranked the second highest momentum stock in the NASDAQ, meaning it should have some more legs and should run higher. Now, again, if you want to know what this TSI scanner is and momentum and all that, then just check out the training, because that's where we go over it. But let's move to the next stock, Revlon. You guys know Revlon, right? They sell all the beauty and personal care products, shampoo, mascara, all that good stuff to make you look pretty in the morning. Well, this is a stock that's being held in the Middleman Value Fund. So what we like to do at Macro Ops is kind of collect all the research from all these different funds and kind of see what we like. So you can piggyback off these value guys who just do great research, But then it's always nice to overlay some technical analysis so that you're not trapped in dead money. So the nice thing to like about Revlon right now is the 50% gross profit margins. Of course, you're going to have generally high margins on stuff like shampoo. Costs $2 to make and then you sell it for $20. Beautiful business. Perfume is even better. Another nice thing is the 87% insider ownership. And insider ownership is basically how much are the executives at that company holding onto their own stock. Because if the guy working at the company, especially one that's high up, believes in the stock price or believes that it's going to go higher, which is why he's holding on to so much, that's a good sign, because that guy's going to know way more than what you or me will ever know. He's an insider. So it's always good to see a high percentage of insider ownership. Another good thing about this company is that it's a large one. Revlon has been around forever. So they have some solid cash to help them sustain what's about to happen during COVID. A lot of businesses struggling, so the bigger ones are better off because they've been around longer and have that cash buffer. If you're a startup or a small company that just started, it's going to be a lot harder. Another good thing is that they improved their short-term debt. But what's not to like is that they're very over leveraged. They got a lot of debt on their balance sheet. And debt is not necessarily good in a business. It depends how productive that debt is. But in this case, they are just over leveraged and need to get rid of some of that debt. Another downside is that they took a 20% sales hit due to the coronavirus, or as I like to call it, the proper name, CCPV. So this is Middleman's take. Revlon's mass market positioning, except for that 20% sales drop, which occurred from their prestige brand Elizabeth Arden, they should be in a good position to benefit from the trade down effect. And the trade down effect is basically people switching from their fancy shampoo to their, generic shampoo. Well, in this case, not generic because it's still Revlon, but the cheaper stuff. And Revlon has more than just their fancy brand. They have the cheaper stuff that's still good. So most likely their customers will just switch to that. And more people will be buying because more people switch to the cheaper stuff during recessions. And also, Revlon is over leveraged, but it will likely sell its hair color business or its fragrance business or that Elizabeth Arden's fancy brand. And because those are all profitable parts of the business, it's enough to deleverage the balance sheet. So that debt problem will be helped a little bit. So right now, if you look at Revlon, it's pretty much in this wider consolidation period. Now, how you play it is really up to your own strategy. You could wait for it to break above this resistance line, or you could wait for it to touch its support line and bounce off. And you could try to catch it at this lower range. But that's always a bit more risky because look at this. If you try to catch it down here, went up, came right back down. Then again, if you're holding for a longer period of time, that might be okay. Really comes down to your strategy. But it's looking like a fundamentally sound business, especially in these CCPV times, where I know it doesn't look like a recession is coming because of the stock market just going bonkers, but most likely it is. And you're going to want these companies that are able to survive through it. Next stock is Sharp Spring Incorporated. And this is once again a play from another value fund, Greenhaven Road Capital. The manager there is Scott Miller. So he said Sharp Spring sells software that enables marketing automation, primarily to marketing agencies for small and medium-sized businesses. And fortunately, they don't have large exposure to travel, retail, or restaurants. So that's good for the times right now. But if a business business does stop all marketing or ceases to operate, they're obviously going to cancel their SharpSpring contract. Marketing budgets are some of the first things to be cut during difficult times. So that's the risk right there. But on the more positive side, SharpSpring pricing compares very favorably to competitors. So they may be more likely to win new business for those seeking a high quality, lower cost marketing automation solution. So they're beating their competitors out on price. Currently, shares are trading at an enterprise value to sales of less than 2. So it seems pretty undervalued right now. And absent a multi-year depression, then the opportunity exists to see very substantial returns from here. So the company is losing money on a GAAP basis, which makes sense because they're aggressively spending to grow their market and reach new customers. They're reinvesting. And at some point, they're going to turn those profits on. But until then, they're financing their operations externally by issuing more shares. Now, if you take a look at the price chart right here, it's looking like it wants to break above this level, right where the 200-day moving average is at 987. But it is a resistance level, so you kind of got to see and watch if it breaks above. So if you wait for it to break above, that's the most conservative entry, and other people will like to buy right now with the bet that it will break above. Me personally, I always wait for a breakout, depending on which strategy I'm using. Now, again, if you look at it, you got that tight consolidation right around this line. And once again, you see volume drop down real low. Now, what is concerning is that the price did start to drop a bit and on slightly higher volume, but it's still a little too early to tell if this thing is just going to be completely rebound back down to lows. This is one that you got to watch. And there you have it, 3 more stocks that you could take a look at in these markets. But once again, they're just stock picks. You need to do your own research before you buy them and make sure you have your own strategy, because the strategy is the most important part. So once again, if you need help with that strategy, I put together this training that shows you how ours works, so you could use it yourself. Literally copy it if you want. Link to that free training in this video and down below in the description and comments, so definitely check it out. And if you haven't already, subscribe to this channel, hit that like button, do all those good things, and I will see you in the next video. Stay fallible out there. Bye.